Listen only mode.
Yeah, good evening, members. Good evening, all Islam members, and a very warm welcome from Team Training and Education for today's session. Today we are conducting 51st webinar in Gyan Ganga series, and today's our faculty is Mr. Milind Harslkar sir. And today's our topic is engineering endorsement part 1. So I request Milind sir to start with today's session.
Yes, just 1 minute.
Just 1 minute. Opening the.
Why this PDF is opening? 1 minute.
PDF is opening 1 minute.
Hey, 1 minute.
Hey, 1 minute.
Yes. Members, please bear with us for the technical problem.
So, good evening, friends. Today's topic is engineering endorsements. Now, just everybody is knowing all these policies. Just to know that what are the policies in engineering insurance, project insurance, and operational policies. Project insurance, you have erection all this, contractor all this, combined project insurance, advanced loss of profit insurance, marine cum erection insurance. This combined project insurance, many may not be knowing. This is mostly given to the mega projects. That is sum insured about 2,500 crore and above, and it is tailor-made policy. And in operational policies, you have machinery insurance, boiler and pressure plant insurance, electronic equipment, contractors plant and machinery, civil engineering, completed risk insurance, deterioration of stock insurance, loss of profit insurance, windmill package policy, and combined machinery. This combined machinery policy is again given to mega policies, about that is sum insured about 2,500 crore at one location, and it is covering all the types of machinery. Now here you have separate policies for machinery, boiler, electronics, CPM, and all that. That is a combined policy covering all these machineries in the insured premises. Now, today's topic is endorsements, engineering endorsements. I will just initially talk about what is endorsement. Now, if you go through various endorsements in engineering, fire, or any other policy, you will find these terms used for the endorsement: clauses, conditions, warranties, endorsements. So legally, there is a small difference in all these things. But as far as today's topic is concerned, all these types of things we are going to discuss for engineering department. And there are non-standard endorsements also. This classification standard and non-standard is based on the what is allowed in the tariff. That is called a standard endorsement. What is not given in the tariff, it is a non-standard endorsement. In engineering particularly, the tariff provides for so many things in the tariff, but TAC had not given the endorsement. So each insurance company follows some certain wordings. There may be small difference, but the provision in the tariff is there to take care of that provision. If insured opts for it, these non-standard endorsements are attached to the policy. And this is what we call is a not forming part of the standard policy wording, but attached to the policy if required. This attachment may be at the start of the policy, along with the policy, or subsequently. So basic question is, why should we understand the endorsement? What are these, and is there need to understand it as a surveyor? Yes, certainly, because the assessment admissibility can differ with this wording. Explaining in the training, yes, because so many times what we find is if somebody is not conversant with some policy and suddenly some out of the thing is some claim is allotted to him, he may not be understanding it. So it is better to explain these endorsements in the training. The standard wordings, that is TSC, non-standard wordings, but as per the tariff provisions, or Insurance Act. So these will be maybe small difference for the non-standard endorsement in the wording for each company. Then beside this, there may be some additional conditions for endorsements put by some company based on their underwriting practices. Those are individual things, so that they being not common, they will not be discussed. Only standard and non-standard as per the tariff provision. They will be discussing those endorsements. So why endorsement come into picture? Is the policy, the practice of insurance, the insurer is to issue a policy in a standard form covering certain perils and excluding certain perils with certain conditions for a named peril policy, and in on-risk policy specific exclusions. Endorsement, what is the endorsement? Is amendment to any one of the standard policy provisions, conditions or exclusions that is modified by the amended by the endorsement. So what happens is that amended provision will be when it is issued along with the policy or subsequently. When it is issued along with the policy, from the day one the amended provision applies. If it is issued subsequent to the issue of policy, from the date of issue of that endorsement, that amended provision will be applicable. So this endorsement, it can be written separately on a policy or written on a separate sheet of paper and attached to the policy. So like say third party liability in project policies, it is given in the standard policy wording only. So if somebody takes TPL cover, that standard wording is there. There is no need to attach. But if they take additional custom duty or air freight or like that, those are attached separately on a sheet of paper. And policy and endorsement attached at the time of issue form an insurance contract. And if it is amended, the amended provision amended subsequently after issue of policy, then from that date it becomes part of the contract. Need for amending standard policy wordings may be due to various reasons. Some examples are coverage of additional perils. Now, if you take engineering policies, cover for terrorism. Terrorism is an additional peril. So, if the insured opts for that, it is the endorsement will be attached. In nowadays, because of separate rate for STFI earthquake. If earthquake premium is not paid, it is excluded. Otherwise, if it is earthquake premium is paid, it is additional peril coverage. Then modification of basis of indemnity. So many add-on covers which are available in engineering policies or other policies, they are basically modification of basis of indemnity given in the standard policy clause. Then modification of some conditions in the standard policy. There is some condition in the policy, you are modifying that condition. So that basis of indemnity modification is one of the such condition. There can be other things like say CPM policy. There is an exclusion that underground machinery is excluded. Now there is a provision. If that underground machinery needs to be covered, insurer may agree by charging extra premium. So that is a modification of the condition in the policy. Then there may be some endorsement where loss minimization is required to be there. So in case of loss, the loss should be minimized. The firefighting facilities condition in the project policy is an example of this. Then loss limitation. So insurer doesn't want their liability in case of particular types of losses to be exceeding certain limits. So they put such condition. The example is the distance warranty in CR policies for road construction. So there the insurer is limiting their liability 1 kilometer at a stretch and total 3 kilometers. So that is a loss limitation. So they want to restrict their liability maximum limit. Then there may be some risk improvement endorsements. They will say that you have to do this thing like firefighting. That is improvement. So if firefighting facilities are there, the losses due to fire are reduced. Then deletion of some policy provisions, conditions or exclusion. Any other thing in the policy, if it is modified by some certain thing, then that can be the reason for endorsement. And then most common these days is policy drafting errors. Policy insured has requested for certain cover. Insurance company is issuing a policy not exactly as per that thing, but by something else. And these errors, if insured points out immediately, it is modified, policy is modified at that time only. Otherwise, most of the time it is after loss. Loss is there, then that time it is found that this the dispute arise and there are issues that then the insurance company says no, this was requested by insurer, will pass endorsements, or without passing endorsement they may pressurize surveyor to give the loss assessment as per the correct provision. Then there are certain endorsement issued after policy is issued. These are some of the examples in engineering department. Installment premium. As per the Insurance Act, the insurance rules provide that when the policy period is more than 12 months, the premium can be collected in installments. So when premium is collected in installment, there has to be some rules. Some companies attach endorsement for that. New India Assurance is attaching the endorsement. That endorsement I will be discussing in due course. So there is an installment premium endorsement. So once you collect the installment on the due date, you have to say that the premium is collected and the policy is valid for next 3 months or 6 months, whatever is the installment gap period. Then continuity of cover after the gap. Suppose there is a delay in payment of installment premium or renewal or extension of the policy for project policy, then there is a gap in the premium. So if you go to section 64 BB of Insurance Act, which says advance payment of premium, there is a delay in premium payment. So during the gap period, the insurance company is not liable to pay the loss, but that has to be modified in the policy. If policy is not modified, then as a surveyor will not come to know that whether there is a delay in payment of premium and all that. So you may assess the loss even during gap period. You will recommend also. But if this endorsement is there, there is a gap. During this gap period, no loss is payable, even though otherwise loss is admissible. But since policy is not valid during gap period, the claim may not be payable. And additional coverages, either peril, sum insured, equipment, location, etc. So these are examples. Some additional peril, midterm inclusion of say earthquake peril in CPM policy or electronic policy or project policy, or sum insured revision. The sum insured is increased, so insured request for the increase in the sum insured. So he pays additional premium, the endorsement is passed. So the effect of such endorsement is from the date when the premium is collected. Then some additional equipment may be covered in machinery breakdown. Some additional location is added in the floater policy, like that. So additional coverage either for peril, sum insured, equipment, location. Then financial institute inclusion. Although as a surveyor we are not concerned, but just example I am giving. When policy was taken, there are some 4 financial institute from where the insured had taken loan or hypothecated their machinery. But then subsequently he takes another hypothecation or additional loan from some other financial institute. That institute will insist that their name should be there in the policy. Then extension of policy period. This happens for project policies mostly. The original policy period is there, the project is not completed, the insured request for extension, and the policy has to be modified. That period of policy is extended from this expiry date till further 3 months, 6 months, whatever they have taken. Then typographical errors. These are not a policy drafting, not a coverage aspect, just typing error. Name is typed wrongly, address is typed wrongly, or like that. So those are typographical errors. Though endorsements, whatever different endorsements are there, they may involve additional premium or additional excess. They may not involve any premium or excess change. So endorsement, as I had earlier told you, usually affect part of the standard policy. So only some small portion of the policy is affected. Thus, it is necessary to end the endorsement with words like, these are the 2 standard wordings. Most of the endorsement will have one of these, or some endorsement may not have, but this should be there to indicate that nothing else is changed. Only whatever is affected, that much portion which is stated above or below, that has only changed. That is subject otherwise to all other terms, conditions of the policy or endorsed there too. So original policy and other endorsements also. So all other things remain same except the whatever is stated in the endorsement. Second is all terms conditions of the policy remain unaltered except as above, that is whatever is changed by the endorsement. So if you go to, now this is general about endorsements. Now if you go to engineering insurance endorsement and you analyze all the endorsement of engineering department, you are having some endorsement which are common to all the engineering policies, whether it's a project policy, operational policy, and various policies under those two heads. Some endorsements are common. Then endorsements applicable to project policies. Some endorsements are applicable to project policies, CR and ER, they are common, both policies. Some endorsements are applicable to operational policies. All operational policies, there is a uniform endorsements, whether this policy is machinery insurance, electronic or CPM. The same, if that add-on cover or the provision is to be changed in the policy, the endorsement wording is same. And then after these three, for individual policies like ER policy, there are specific endorsements applicable, CR policy separate, MB separate, like that. So we'll go by this sequence for ease of understanding. So first is endorsement applicable to all policies. Now these are the endorsement which are applicable to, common to all the engineering policies. Air freight, deletion of earthquake in zone 1 and 2. This was the earlier endorsement. Now since zone 3 and 4 also premium is chargeable, same wording may be used for 3 and 4 if it is earthquake zone 3 and 4. Then coinsurance, terrorism cover, exclusion of terrorism cover, additional custom duty, express freight, owners surrounding property, and third party liability. These are the common endorsement applicable to all engineering policies. Out of this terrorism thing, I am not going to discuss here because the latest wording I could not get in this short time. Old wording, discussing old wording is of no use. So only out of this 9-7 I am discussing today. Air freight endorsement. In the policy basis of indemnity, the policy provides for payment of freight as included in sum insured. The word used in the policy is as included in sum insured. So all the engineering policies, MB project, anything you see in basis of indemnity, they say that the freight is allowed to the extent it is included in the sum insured. So mostly the freight is for sea or rail or road, or maybe some combination of this. So that is a freight. But in case of loss, the parts may be brought to site by air. So due to urgency, the insured may say that urgency, so they will bring by air. The freight charges is vast difference in the freight charges. But since the original policy standard clause says that only to the extent included in the sum insured. So if it is a road freight, maybe 2% or 1% of the value of the consignment is allowed. But when it comes by air, the freight charges will be substantial compared to this. It's a small item. I say 1 lakh rupee, but a freight may be 10,000 rupees by air if it brings. And if you take 1 lakh 1%, it is 1,000. So he is losing 9,000 rupees. But this add-on cover is available. And if insured opt for this add-on cover, there is a need to modify this basis of indemnity. So the endorsement wording is given standard by in the tariff. So this is a modification, basically a modification of basis of indemnity. Only the modification is for freight, nothing else. As I told you earlier also, it is modification is only freight charges. So air freight is there, we will allow air freight. There is a limit taken, up to that limit it can be given. There is a separate excess for the freight charges, which air freight charges which will be paid. There is separate excess, not the standard excess for the equipment or project or whatever is there. This is additional excess on that air freight charges. The limit opted, insured whatever limit he has opted, it gets reduced by the amount of claims paid. So if you are doing a survey midway of the policy, then you can qualify for air freight, that insurer to check earlier amount paid. You can assess the loss for this claim air freight charges, but whether that amount is payable or not payable, the insurance company has to decide, because you are not knowing how much air freight in earlier claim, whether it was involved and if it is paid. So you are not aware. So that is the insurance company to decide whether air freight you have assessed is payable to the full or partial. So that is, but you have to comment on this aspect. So this is the wording. It is hereby declared and agreed that the policy shall also indemnify towards air freight, clearly mentioned air freight, incurred by the insured in connection with the indemnifiable loss under the policy. Whatever loss is indemnifiable for repair, replacement of that machinery, whatever expenses for air freight are incurred, that will be assessed by you to the extent sum insured limit, whatever he has taken up to that. So this additional premium, each and every claim shall be subject to a minimum excess of 5%. This is a 5% excess is there. Now see here the last slide, subject otherwise to terms, conditions and exceptions of the policy. This clearly indicates that no other provision of the policy changed except the freight charges in the basis of indemnity. Then coinsurance. Coinsurance. This is a non-tariff provision because tariff doesn't say that insurance has to be with one company or more companies. But practice is insurers, there are more than one insurer. So this is endorsement is restrict liability of the insurer to the extent of his share in the policy. So this is a modification of insurer. Instead of one insurer, there are more insurer. Such provision is a non-tariff provision and is administered as per the agreement between the insurer. The wordings are standard wording because it is a common endorsement agreement of the insurer. So the wordings are standard. If you go to any policy, you will have the standard wording. So this is a New India insurance I had taken, so that insurance company name I have mentioned New India, and that other companies names will be mentioned. So percentage is mentioned. So as per this thing, the assessed loss will have to be given in the report. This company this much, this company this much, whatever percentage wise it is to be given. Then additional custom duty. This is a tariff endorsement. This is again the basis of indemnity says that custom duty is to be paid. Admissible is only to the extent of included in the sum insured. So in case of loss, again custom duty may be more because machinery duty is one, project duty is different, spare part duty is different. So sum insured may have the machine duty or project duty, because project duty may be exempted, so he may not include in the sum insured. So zero, it may be zero. So here, then replacement, he may have to pay the duty, so that additional duty has to be paid. If this cover is opted by the insured, then there is a need to modify this basis of indemnity as far as custom duty is concerned. So again, this is a modification of basis of indemnity. For this also, there is an additional excess available. The limit of for additional custom duty, originally whatever is taken, if there is a claim paid, the insured can reinstate it to original value. Suppose 50 lakhs was the additional duty taken, 5 lakhs duty claim, additional duty claim is paid in some loss earlier. Insured can pay that 5 lakhs premium for the additional custom duty. So during balance policy period, the 50 lakhs will be available. So here, what you have to say is, if not reinstated, this is my assessment. Additional duty assessment, if it is given, it should be with qualification that this is additional custom duty as for this claim. If limit is available, this is payable, admissible. Now this is the standard wording. In consideration of insured having paid additional premium, so indemnified during the currency of policy, each and every claim payable, this is the excess. This is a custom duty of amount of, this is a fixed amount he has to select. It will be mentioned here by the insured over and above the custom duty amount taken into account in arriving at the sum insured. So whatever custom duty he has taken into consideration in arriving the sum insured. So he has exemption, he has included zero duty in the sum insured. So actual duty paid will be payable. In case there is a loss, if he pays 20%, 20% can be considered under additional duty. The indemnity for such additional custom duty will stand reduced. So this is payment that I have explained. It can be reinstated. For competition of indemnity under the additional custom duty extension, exchange rate applicable on the date of occurrence of loss shall be considered. This is a very important aspect. So date of loss, actual import may be after 6 months. That time the rate of exchange may be different. So here they are not saying that minimum of the two. As on date of loss, whatever was the exchange rate, that has to be considered to arrive the value in rupees. So TSC had given this working also. This is a new circular, because I have that circular 1989. This provision calculation was given by TSC. In those days, the TSC used in engineering TSC committee, they never used to issue circular in those days. They used to issue minutes of meeting, and based on the minutes of meeting, each company used to issue circular. So these calculations were given in that minutes of meeting. This is a new circular which I had. So I am giving this calculation. Now sum insured is 2 crore. Excess is 2 lakhs. This is a machinery breakdown policy example they have given. Depreciation 40%. Salvage 1 lakh. Original custom duty 20%. Custom duty for replacement 90%. Spare parts were imported. Those days the custom duty difference was very heavy. CIF cost of imported component is 20 lakhs. Oh, sorry, 2 lakhs. Small component, 2 lakhs rupees component, and spare part duty being high, 90% duty was paid. So the calculation of basic cost of the material as per the policy, considering that additional duty is not there. So 20% is included in the sum insured. So we are considering 20% here. So 2 lakhs, 20% is the additional duty. Landed cost is 240. Less salvage, 10,000. Net of salvage, this is 2,30,000. Less depreciation, 40%. Net assessed, 1,34,000. Excess is 2 lakhs. So basic claim payable is 0. Now come to additional custom duty. Original duty 20%, replacement duty is 70%, additional duty, this is difference is 70%. CIF value 2 lakhs, additional duty to 70%, 1,40,000, excess 5% of this 1,40,000 is 7,000. So net payable 1,33,000. So 1,30,000 will be payable as additional custom duty. Basic claim 0. And the next endorsement, which is standard endorsement for all policies, is express freight. The policy provides that the charges for labor are paid at normal rates, because that is included. Cost of erection or other labor charges, standard rates are included, normal rates. In case of loss due to urgency, the repair reinstatement work is done on 24 hours basis, on Sundays, holidays, or expenses. If some person is deputed to bring parts from the supplier, or supplier person is said that you bring the part with you by air or whatever, normal urgency. So this is an additional cost which is not part of the sum insured. The holiday rates of wages, Sunday rates of wages are much higher than the normal rate, mostly double. Then somebody goes there, his expenses will be involved. He's going there, coming back. If he comes by air, the freight charges for air, even accompanied luggage charges will be more. So all the charges, they are called as express freight. So this is again a modification of basis of indemnity. There is additional excess applicable for this. This is endorsement wording. The insurance shall be extended to cover extra charges for express freight, excluding air freight. So air freight is not payable. Other than air freight he has to take under air freight, not here, but other expenses are paid here. Provided always such that such extra are incurred in connection with any loss of or damage to insured items recoverable under the policy. So such cost has to be for the damaged item which are indemnifiable. If here the basic indemnity is not there, this thing also will not be payable. If the sum insured of the demand items are less than the amounts required to be insured, the amount payable under this endorsement for such extra charges shall be reduced in the same proportion. That means under insurance will be applicable for express freight, whereas for additional duty and air freight, there is no under insurance. They are maximum limit is whatever is given, up to that limit they can get. But here under insurance is applicable for express freight charges. So while calculating the under insurance basic claim, and this express freight amount also has to be added for calculation of under insurance. Then owner's surrounding property. This is again tariff wording common to all policies. The policy specifies the subject matter insured. So what is the subject matter? If it is a project, whatever project name is given. If it is a machinery insurance policy, a list of machinery will be given. So the only damage to that subject matter is covered. Now, if damage to subject matter, subject matter your insured property is there, it can cause damage to other properties nearby also. So insured, if they want to cover those damages, this endorsement is there. Only thing is that it should be owned by the insured, or it should be in their custody or like that. So insured, if opts for this cover, the damages to this property are to be paid. Insurers attach endorsement to make admissible such losses. So this is basically a modification in subject matter. You are extending the subject matter from insured property to surrounding property also of the insured or under its custody. The limit of indemnity is maximum amount payable during policy period, and hence no under insurance applicable. So here, this is the endorsement wording. Extended to cover loss or damage to property located at or adjacent to the site. So whatever is the address given in the policy as an insured address, insured premises. So it may be at the insured premises, or it can be adjacent to the site, so nearby property, and belonging to or held in care, custody, control of the principals or the contractors. Since this is a common endorsement, these words are like this. Operational policies also and project policy also. So the principals and contractors is used. If occurring directly due to damage of items mentioned in the schedule. So whatever your this loss to this should be because of damage to the insured property in the schedule while at rest or in use for construction or erection during period of policy. So this is common. So this erection wording is used. The company will pay to the insured the value of the damaged property at the time of accident. So value of the damaged property at the time of accident means depreciated value and not the replacement value. If it is a machinery insurance policy, normal indemnity is replacement value basis. But here it is a value of the damaged property at the time of accident. So depreciation will be applicable. How old is that surrounding property? Depending on that. So excess, whatever is applicable to the equipment or same policy excess will be applicable. So this will be in addition to the insured property, because insured property there has to be damage, then only surrounding property damage is there. So total together one excess will be applicable. In respect of loss or damage resulting to underground piping, tunneling or underground cables and other underground facilities, the indemnity will be restricted to the actual repair cost. So repair cost provided prior to commencement of work, insured ascertains with the relevant authorities about the exact location or positions of such cables, pipes or other underground facilities, cracks that neither impair the stability of the structure nor safety of the. So for these items, the prior knowledge should be there to the insured. Then third party liability. This is again a common endorsement. Policies for material damage to insured property, standard wording. So again, surrounding, it can be insured's own property or somebody else's property. So same thing, the property can be damaged, others' property. So this is add-on cover available. If this cover is granted, there is the need to modify the policy to enable such losses being admissible because add-on cover is taken. So there is a limit of indemnity for TPL cover. Beyond that, insured may have to take separate policy. The policy provides how much third-party liability can be taken in particular policy. So in project policy, it is 10% of sum insured 1 crore or 10 crore, depending on the sum insured 100 crore or above 100 crore. Then cover is in machinery breakdown also there is a limit, some few lakh rupees only. Cover is for property as well as personal. So third party liability can be because damage to property also or some personal getting affected. So this is a modification of subject matter basically. So subject matter you are modifying. What is insured? So this is policy wording. Against legal liability. So legal liability means normally legal liability follows the principle that is law of tort. If someone has done wrong to you, you can claim from him the damages. So basic thing is if insured has done something wrong and damaged others' property, the others can lodge a claim, but provided others are able to prove that there was some wrong done by the insured. So negligence or other aspects has to be proved by the claimant. So if insured is legally liable, mostly such claims are settled in court. So if it is found to be legally liable, then insurance company will pay. Accident, loss or damage caused by the property of others person. Then this is for the property. This is for the personal. Legal liability. Liability under contract accepted. So here liability under contract accepted means for the personal, the employees, there is an employees liability insurance has to be there. So that is as per the contract. So this will be excluded. WC claims cannot be there in this thing. Then other persons in the premises, that is non-fatal injuries to any person other than insured or his own employees or employees of the owner of the works. If it is a multiple occupancy ring, owner of the work is employees or site, premises, location or employees of the other firms connected with any other work site, premises. So project policies, there may be so many contractors working. All contractors, workmen will be excluded. And they are members of their family. So many times in project site or even in so many factories, the workers with family stay in the insured location. So their family members also, they cannot come under the third party liability. These are the exclusions. First amount, that is excess expenditure incurred in doing or redoing or making good of repairing, replacing anything covered or coverable under the policy. So whatever can be covered in the particular policy, it cannot be coming under the third party liability. Now this problem comes for project policies. Two contractors have taken separate policy. Then that to avoid this thing, the cross liability cover is taken. So here it is excluded. Then this is again personal, same thing, whatever is mentioned there, same thing is again repeated for the people. Bodily injury to illness to employees, workmen, members, all those things were earlier mentioned, again repeated as an exclusion. Then loss or damage to property belonging to or held in trust by or under custody of the owner. So this can be only surrounding property coverage. So they cannot come under the third party liability. Any accident caused by vehicles licensed for general road use or waterborne vessels or by aircraft. So this is a tricky situation because so many vehicles licensed for road use like dumpers and tippers and like that, they are used at project site. Now this, if they cause accident and there is a third party liability, then this is a tricky situation. Any agreement by the insured to pay or any sum by way of indemnity or otherwise unless such liability would have been attached also in absence of such agreement. So this is to take care of it. So many times under local pressure, insured pays certain amount and then the insurance company will say that we are not liable because this is not coming under the purview of the policy. So this is no admission, offer, promise, payment shall be done by insured without consent of the insurance company. So this is a safeguarding by insurance companies. The company may, so far as an accident is concerned, pay to the insured the limit of indemnity for any one accident or any one period after deducting therefrom, in such cases, any sums already paid as compensation in respect thereof. So it's a earlier some on account payment and all that. That is. Now this is as far as those 7 endorsements which are common to all the policies. Now endorsement common to all operational policies. There are 2 endorsements only which are common to all operational policies: escalation and cover for imported machinery. Now you may be wondering, escalation is also there in the project policy, but the wordings are different. So I have made here separately. Endorsements common to all operational policies. Escalation is separate, wording is separate, the provisions are separate. Escalation provision under project policy are separate. The escalation policy provides indemnity for the value insured, that is the maximum liability. It is known fact that values may change during the period of insurance. This is a operational policies are mostly annual policies. Even during that periods, the values change. So insured is supposed to revise the sum insured. He doesn't do that. So he will get the original sum insured only. But since nobody can predict how much change can be there, so this provision has come into picture. So insured can take the escalation clause. If escalation clause is taken, then there is a need to modify this thing for the basis of indemnity. So that change is affected by this endorsement. The insured has to select escalation. It is in percentage. So 5%, 10% like that. The insured may opt for selected machinery. So if he has 20 machinery in a particular policy, it is not necessary that he should take escalation for all 20 machinery. He can say that I want only for this 5 machinery. So again, those 5 machinery, again, it is not necessary that he should opt for uniform percentage of escalation. He can opt different percentages of escalation for each machine. So that schedule, escalation endorsement schedule will show how much percentage of escalation is there for particular machine. So this is basically modification of basis of indemnity. Maximum escalation percentage can be taken is 50%. Now if you see this wording, this item number. So what is the serial number in the schedule? Specified percentage increase per annum. He has to give the percentage. He can have same percentage for all machine. He can have a different percentage. Now the escalation is increasing here. The annual premium then during the period of insurance be increased each day by an amount representing 1/365th of the specified percentage of the income. So if it is a 10%, so 10 into 1/365 per day increase in the sum insured. This is here it is a per day increase. So the loss is on say 185th day. So that 185 into whatever this percentage will come, it will be like that. So that much increase in the sum insured is allowed. He is insured up to that much amount. So unless specifically agreed to the contrary, the provisions of this clause shall apply only on the sums insured in force at the commencement of the policy. Now this provision is because there is a provision in the policy. The insured can increase the sum insured during policy period. Suppose he has increased after 3 months the sum insured. The original sum insured was 10 lakhs. Then the prices increase, so he is increasing that 10 lakhs sum insured to 12 lakhs and after 3 months of the policy. So if insurance company doesn't agree that on the escalation is available on 12 lakhs, the escalation will be available only on the 10 lakhs sum insured, not the 12 lakhs. Normally it should be 12 lakhs. So insurance company has to specifically agree. So if that sum insured is revised in that revised increase in sum insured endorsement, the insurance company should say that the escalation will apply on this revised sum insured. Then only you can apply escalation on 12 lakhs. At each renewal date, the insured shall notify the insurance. This is the insurance company to So renewal time, the sum insured should be increased with this percentage and all that. So same thing for the increase in the sum insured only. Then insurance of imported machinery. For this, this is a certain costs are incurred when you have to send the machine for repair. If the machine is sent for repair to abroad, then so many these other costs are involved. So those costs are not payable because they are not part of the sum insured. So that is why this endorsement is attached. Indemnity provides by this policy does not extend to include cost incurred, time involved in the movement of machinery and or any other property and or personnel outside territorial limits of India other than cost of delivery of replacement for machinery lost or damaged. So this is other cost. Normal repair costs are payable. These are the other additional costs which may be involved. The endorsements common to all project policies. Now these are the common endorsement. Thus refund of for early completion is a non-tariff. So some endorsements I will not be talking. Refund for early completion. We are not concerned with that as a surveyor. Then these are the other. There are 16 endorsements which are common to CR and ER policy. So these are non-tariff endorsements, and with that I am not discussing here. Only this earlier one, this one, this 7 and this 2. 9 I will be discussing. Escalation. Now escalation provision here, the principle is same. It is modification of basis of indemnity. Now here the escalation again is a percentage of sum insured. Now here the insured may opt for different escalations percentages for imported machines and indigenous machine and civil work. If it is there, civil work also insured, civil work. He can have separate escalation percentage because the escalation in prices for imported may be at different rates, indigenous may be different, civil work may be different. But then that has to be there in the policy, specifically mentioned like that. Then here also maximum escalation allowed is 50%. The basic difference in operational and this is the basic difference. That is, if insured opts for 20% escalation in the policy, that 20% is available from the day one of the policy. Whereas there it is 1/365 into 20%. Here it is from day one, 20% escalation is available to the insured. So here again, that has to be original site value. Now this original site value means whenever that equipment has come, what was the value? That is the original site value. It is presumed that that original site value is included in the sum insured fully. There may be possibility of this original site value may not be included. If there is a price variation clause, he is including only that thing. He doesn't consider price variation clause. Only the BOQ rates he is considering. Then there can be issues. The basis of claim settlement shall be original site value of affected equipment plus increase in cost of replacement if any. If there is an increase, maximum is the whatever he has selected. Under insurance will apply after that as say 100 is the sum insured, 20 is escalation. So beyond 120, if the value goes, then only under insurance will apply. 120 divided by say replacement is 130. So 120 by 130 will be the under insurance. Then maintenance cover. Now this maintenance cover, there are two types of cover: limited maintenance cover, extended maintenance cover. So policy provides period of insurance. So this policy provides period of insurance. If this maintenance cover is taken, then they will show after that this much period, 12 months or 24 months maintenance, whatever is agreed by the insurance company. So the policy says that during the original period of insurance only the losses are payable. Whereas as per the terms of contract, there is a defects liability period they call it as, we call it as a maintenance period. In maintenance period, there can be loss. There can be two reasons which we are covering, only two reasons are for those losses. So if such losses are there, since it is the original contract related to original contract, this extension is asked by the insured. So insurance company agree. If that agreement is there, then such losses are payable. So basically this is modification of period of insurance. So what are payable? Loss due to cause happening in policy period, but actual loss occurs in the extended period given under extended maintenance. There is another which is provision which is there in the limited maintenance also and extended also. As per the agreement of the contract agreement, insured, the contractor is supposed to come to the site if there are any defects or some problems are there. While rectifying those problems, the other insured property gets damaged. So those damages and this loss due to the cause is during policy period, erection period, and the actual loss is in the maintenance period. These two types of losses are payable. Attached to and forming part of policy number so and so. So from the date of completion of the testing. So this period, extended maintenance period, will be starting from date of completion of testing period. This provision is most important, provided that policy period has been extended till completion of testing. However, during the maintenance period, this insurance shall cover. So what is it covering? Solely loss or damage to the contract work, so insured property, caused by the insured contractors. So another important one is insured contractors. Now, what is the insured contractor whose name is there in the policy? That is most important thing. And in the course of operations carried out for the purpose of complying with the obligations under the maintenance provisions of the contract. That is, some certain things are there, some issues are there, whatever those issues are mentioned in the contract, for that he has to come and rectify those things. So this is a limited maintenance cover. But the basic conditions are the policy is extended to completion of testing, and the maintenance agreement is by the insured contractors. The insured contractor who has done the work, his name doesn't appear in the policy. Then this maintenance cover is not available. It has happened in one of the major laws. These two things were not complied with. Policy was not extended, full testing was completed, and the insured contractor, the contractor who had done the work, was not named in the policy. And there was a major loss of 7 crore or 10 crore during the maintenance period. Now this is extended maintenance. Here again same thing. Policy period has been extended till completion of testing. However, during the maintenance period, this insurance shall cover loss or damage to the contract work caused by the insured contractors in the course of the, now here caused by the insured contractors. So again, the name of the work, whatever contract, the erection, construction work is done, that contractor should be named in the policy. The case I told you was during extended maintenance cover was there. The insured contractor, original contractor was there. In between the policy period, insured the total contract was there. Out of that, 40% work was shifted to new contractor, but that new contractor name was not part of the policy. In the course of operations carried out for the purpose of complying with the obligations under the maintenance provision. So this is same thing as a repeated maintenance. Then occurring during the maintenance period, provided such loss or damage was caused at the site during the erection period. The loss or damage should have been caused during the erection period. The cause of loss should be erection activity, and the loss is during maintenance period. Those type of things are only covered under this policy. This is the warranty. Same thing is repeated. It is agreed, understood, otherwise that terms exclusion provision, the insured having paid the agreed premium, the insurance shall be extended for the maintenance period specified hereunder to cover this thing. Then installment premium. This is a non-tariff endorsement. This is a New India wording I am giving you. Other companies may have their own wordings. So installment premium, this is non-tariff. Article 1. It is hereby declared and agreed that the insured shall pay the premium stated in policy schedule in installment as per the schedule given. Now here is a old wording service tax. Now it will be GST. So installment number, due date on or before, premium amount and service tax. Like this 1, 2, 3, 4 depends on number of installment will be depending on the period of insurance. Article 2. If the insured should fail to pay the premium up to the date of payment of provided in the preceding article, the company shall not be liable for any loss or damage between such date and the date of receipt of premium. So that means suppose the due date was 1st of October and insured has paid the premium today, that is 17th October. So any loss occurring between 1st October till payment of time, today suppose 12 o'clock they have paid, so up to 12 o'clock, this much period, if there is any loss or damage, that is not payable, clearly mentioned in the policy. So as a surveyor, it is important to find if such loss is there nearby this thing, then it is necessary for us to see the time of loss and date of loss. The insurance company may ask surveyor to confirm this thing. Article 3. In the event of loss or damage caused by the perils against which the company is liable and the amount of indemnity payable exceeds the sum of premium in installment received. Say there is a loss and that loss is say 20 lakhs and it is exceeding the sum of premium in installment already collected. The installment collected till this date of loss is say 15 lakhs. So the insured, notwithstanding the provisions of this article, that is schedule given above, shall pay immediately the next premium. If that next premium is not sufficient to cover 20 lakhs, then next premium. Like that till the amount is fully paid. So the premium collected should be more than the indemnity. Suppose there is a major loss, say 2 crore loss is there and total premium is 70 lakhs. Then balance all premium he has to pay immediately. In the event of additional premium due, that is a provision in the policy policy payment. So we are not concerned with this, the adjustment of premium and all that. So here again, this policy shall be kept in force. That is a normal thing in case of claim. Standard policy also has, but since this is an installment, they have repeated it. The full sum insured is available even if there is a loss. Coverage for CPM. This is a non-tariff. This is not given in tariff. TSC had not given any endorsement for this. But there is a provision in the tariff to cover CPM up to certain limit in the policy. The 25 lakh rupees is the limit. Up to 25 lakhs CPM can be covered in the policy, project policy. So if somebody takes this cover, then there is a need to modify the policy. Again, this is again same thing, modification of subject matter of the insured. The excess is as per CPM tariff and not the project policy. So when you are giving the list of machine in the policy, then the excess also should be mentioned separately. So many times you may find that CPM sum insured is given, but there is no endorsement attached. This is a endorsement has to be there as per this wording here. This is a TSC wording. So attached to and forming part of the policy, so and so it is agreed and understood subject. So insured having paid the agreed premium, the insurer shall indemnify against loss or damage to following contractor plant machinery, subject to the excess specified against each item. So this is a schedule similar to CPM policy. Serial number, description of with nameplate details, make, year of make, excess, normal, AOG. So 25 lakhs is allowed. So 25 lakhs premium is collected, and then policy shows 25 lakhs without this list. Maybe you are having come across such situation number of times, but this is very much required. Policy tariff endorsement is there, it should be attached to the policy. Then expenses related to freight, insurance and custom duty. Again, modification of basis of indemnity. This is specifically endorsement by TSE. So expenses relating to the freight, insurance and custom duty will be paid only to the extent of percentage in relation to the value of equipment covered in the policy. This is what I am referring. Although policy is saying this is a specific endorsement also need to be attached, and that is there given in the tariff. So to the extent it is included in the sum insured, you are not to pay anything more. Now that additional duty or air freight or express freight things, they are modifying this provision. But this endorsement is very much should be there in the policy. And storage risk at fabricator premises. So this provision again is a premises extension. So your project period premises is one thing. Some activities are done at some other premises. So extension of premises, modification of premises for the insurance. So here, subject otherwise to the terms, exclusions, provisions, and conditions contained in the policy. So section 1 of the policy shall be extended to cover loss or damage to property insured, except property being manufactured. So if it is a manufacturing activity, it is not covered. Process manufacturers premises, distributors premises, suppliers premises, they are not cannot be covered here. Properties at railway sidings, transporters and clearing or forwarding agents premises, they are also offsite storages, but then that those are not covered. Offsite storage is actually related to the project activity, they are only covered. In fabricators premises, offsite intermediate storages within the territorial limits of India. So here specifically mentioned all these things are within India, not the foreign countries. So here maximum value per storage unit, limit of indemnity, any one occurrence. Deductibles. So there is a separate excess applicable. It is normally same as storage erection excess. So since this premises is different, the loss at project site and loss at this premises is no way related. So there is a for this premises no texting activities, only storage and erection activities are covered. So this is excesses of storage erection. The deletion of maintenance cover. The tariff has one provision that maintenance cover originally opted, but subsequently insured feel that he doesn't want maintenance cover. Then he can delete it. The tariff provision says that before policy expires, original policy, insured can cancel the maintenance cover. That is, maintenance cover should not have started. Once maintenance cover starts, the this deletion cannot be done. So this is a post policy endorsement. So this is the one company there TSE had not given, so one company's endorsement which I have put here. Then insurance of imported machinery. Again, same wording like machinery insurance policies, more slightly different, but same wording basically. So imported machineries are there, those are extra costs, they are not payable. Exclusion of marine transit losses. Now, if it is only erection of this policy, marine insurance is not with the same insurer, then this endorsement will have to be attached. So there is a 50-50 clause add-on cover is there, but still the marine loss is paid in marine in that thing also. Marine loss is paid in marine section, erection loss is paid in erection portion. So there are disputes so many times. You don't open the consignment immediately, so the loss, whether it is a marine or not, is a dispute. But if it is proved that it was a marine loss, then it is be excluded. So if this endorsement is there, it will be helpful to the insured. So thank you.
So thank you, Milind sir. Let's take a question, quick question. Members, you can raise your hands if you want to ask some questions. We have received only one or two questions. Samirji, can you unmute the members who want to ask some question?
Sir.
Samirji?
Yes, sir.
Yeah, can you unmute the members? I am not able to unmute the members. There is a question from Darshan Shetty. In CPM policy, if insured replacing parts with second-hand parts available in market is 30% less than new rates, in this case, depreciation is must in assessment. Sir, machine is more than 10-year life of machine considered 15 years and under insurance value is 66%.
So can we discuss in the endorsements for CPM? Because these are general endorsements, sir.
Correct.
These are general.
Okay,
I am talking. Yeah. CPM policy endorsements also
correct.
we are going to talk. So that time we can discuss this question.
Yes, so I request Darshan Shetty ji to just write us on training@isla.net. So we'll take this question while we're discussing the CPM policy. Any other
Mr.
question?
Shah Minesh, please self-mute. You are self-muted. Please unmute yourself and ask the question.
Yes, sir.
I think he has connectivity problem.
Hello.
Shah Minesh, are you there?
Okay, any other question? Okay, sir. Thank you very much. Thank you, Harsulkar sir, for this wonderful insight. And thank you all the members, all the participants for attending this lecture. We'll meet tomorrow morning at 11 o'clock. Thank you.
Thank you very much, Milind sir. Have a happy Navratri to all.